All right, so just so we understand each other, what I'm going to do is for each chapter, at the end of the chapter, I'm going to do a problem in problem set B, and for this chapter 14, we're going to do problem 14.6B. And what you'll do for your assignment is you will do a corresponding problem, the problem with the same number in problem set A. So for chapter 14, you will do problem 14.6A. What you'll notice about these problems, the one in A and B, is they're very, very similar. So what I'm doing in giving you this problem 14.6B is I'm giving you the mold, the pattern by which you can do 14.6A. Okay? So in my past experiences with other students in this class and other classes where I've done this, they seem to like it. It seems to work well. So I hope you think so too. I'm not a big fan of Connect. If you want to use Connect, fine. I just think it's lazy teaching. That's my opinion. All right, so let's get started. Problem 14.6b says, shown below are selected data from the financial statements of Hamilton Stores, a retail lighting store. And so they give you the information from the balance sheet. So you've got cash, accounts receivables, inventory, plant assets, current liabilities, stockholders' equity, total assets. You have information, so it's selected information. It's not the whole financial statement here from the balance sheet. And same goes for the income statement. You have net sales, cost of goods sold, operating expenses, interest expense, income tax expenses, net income. And then you have from the statement of cash flows, which I hope you've had some familiarity with, you have net cash provided by operating activities, so forth and so on. So, instructions. Explain how the interest expense shown in the income statement could be $80,000 when the interest payment appearing in the statement of cash flows is only $72,000. Well, the thing about what you're going to see in interest expense in the income statement is based upon what type of accounting? Well, it's based upon accrual accounting. And so when the company accrues this interest expense, they have to book the whole thing, the whole $80,000. But that's different from what the presentation is on the statement of cash flows, because statement of cash flows is not based upon the accrual basis of accounting. It's based upon the cash basis of accounting. And so what's in the income statement has nothing to do with the actual outflow of the interest payment. What you have in the statement of cash flows does. And so what explains this is that apparently $8,000 is paid in the next year, in the next period. So that explains that. B, compute the following round to one decimal place. All right, so you have current ratio. Current ratio is just strictly in terms of how you set it up, is current assets over current liabilities. And so in this case, what we have here, you just strictly take the numbers, and so you're going to have current assets of what? 35,000 cash. You're going to have accounts receivable, 175, and then inventory of 225,000. So you add those up and you come up with $435,000 as your current assets. Just realize that in some cases, not in this case, but in some cases, you might also have some prepaid expenses, which if you recall from financial accounting, you have to, when you prepay an expense that's going to generate a benefit in the future, you've got to book that as a current asset. All right, so we have that. What are our current liabilities? Well, in this case, it just tells you. Normally, when you do this stuff in the real world, you're looking at a financial statement that's not going to give you the bottom line number. So, what are current liabilities? Well, it's all those payables. Accounts payable, wages payable, taxes payable, you name it. And so in this case, they just give you the number, and so that is 190,000. So you just divide that, and what they come up with is 2.3. Now you could state this a couple of different ways. 2.3 just means that you've got 2.3 times as many current assets as you do current liabilities. You could state it this way, 2.3 to 1, which means that basically the same thing. You've got 2.3 current assets to 1 for every 1 liability, current liability. Okay? Quick ratio. Well, if you recall in the lecture, quick ratio takes out mainly inventory. Of course, if you have prepaid expenses, you take those out too. So if we take that out, what we have is the $35,000 cash plus 175 accounts receivable. So 210,000 over 190,000. So that is 1.1 to 1 or just 1.1. Either way, works for me. Working capital. Well, working capital is not a ratio, it's a strict number. And so working capital is current assets minus current liabilities. And so in this case, you strictly just take the 435 and subtract 190. So 435 minus 190 equals 245,000. Is that good or bad? Well, like I said in the lecture, the recorded lecture, this doesn't mean a whole lot. All we know is it's a positive number. Certainly, you've got plenty of current assets to meet current liability obligations. So, I mean, it's a positive number, and that's about all you know. But, you know, if this is mainly inventory, then that doesn't really tell you a whole heck of a lot about how liquid this company is. All right, next, debt ratio. And this is simply total liabilities over total assets. So what we have here is let's see. Tricky. So what they're doing here, and again, normally what you would do if you were like a financial analyst actually doing this in real life, you would have the actual number from the balance sheet. Here, since this is not real world, what they're trying to do is make you extrapolate what total liabilities are. All right, so we can figure this out because it's called the balance sheet for a reason. Total assets, 1,300,000. I'll leave out the last 3 zeros. Remember, A equals L plus owner's equity or shareholder's equity, right? So we know that. And what they give you is total assets, total shareholders' equity. Right? So, balance sheet, both sides have to equal, which means that total liabilities is 800. Okay? So, that's the way you work that problem. So, now we know what we need. We have total liabilities of 800,000, total assets of 1,300,000, and so that's going to equal 0.615. So what does that mean? Well, means that the total liabilities are 61.5% of your total assets. Is that good? Yeah. It's not bad. And depending on what kind of company this is, retail lighting store, it would be nice if this was this number was around 0.5. It's a little higher than that, but still acceptable. If you're getting around a 1-to-1 ratio, that's probably not good. All right. C, comment on these measurements and evaluate Hamilton's short-term debt-paying ability. All right, so I kind of already done this, but 2.3 to 1, as a general rule, regardless of the type of business, anytime you have a 2-to-1 ratio, that's good. Anything higher, better. Now, that's within limits. If you're getting up around 3 to 3.5 to 1, that's still good. If you're getting up around 5 to 1, you'd really have to look at the mix of what's in your current assets, because what the company may be doing is holding cash when it should be invested. They might have too much receivables that are outstanding and maybe not being collected. Or if it's in inventory, they have a large amount of inventory. They may have inventory that's just sitting there gathering dust. So it's higher is better to a certain extent. There's a limit to that, though. Okay. Anytime you have a quick ratio reaching 1 or above, that's good. So they're in good shape from that standpoint. And this, again, all we know is it's a positive number. You'd have to look into the components here. If a lot of this is inventory, well, just because this is positive, if a lot of this is inventory, that's not necessarily making this company liquid. And then, let's see, what can I say about this? Yeah, this is pretty good. I think I've already indicated that. Not bad at all. So, overall, this company, Hamilton Stores, should be able to pay its bills quite handily, and then some. Okay. D, compute the following ratios. Assume that the year-end amounts of total assets and total shareholders' equity also represent the average amounts throughout the year. If you recall, a lot of these are based upon average amounts, which is taking the beginning year amount plus the ending year amount and dividing by 2. So again, they're cutting corners, but that's okay. All right, so we're to do return on assets and return on equity. I'm going to erase this because my camera can only fill in one side of these boards, and I don't want to get too far out on the lens, because if I do, you probably can't see what I'm writing. Okay, so return on assets. So what do we need for return on assets? Well, we need operating income, and we need total assets. Okay? And again, they're a little tricky on how they set this up. So you have to figure out what your operating income is. So net sales, $2,400,000. I'll leave out the last 3. Less cost of goods sold, which is $1,800,000. And so your gross profit is $600,000. And so what you're going to do from that is you're going to take away your operating expenses, which is $495,000. And so operating income is $105,000. Okay? And again, normally if in the real world you're going to have the income statement in front of you, and it's going to give you all this information. You're not going to have to go scrambling for it, but This ain't the real world. This is academia. So they're challenging you to figure out some of this stuff, which is not a bad way of doing it. So anyway, all right. So now that we know what operating income is, we can figure out our ROA. They give you the total assets of 1,300,000. And so ROA equals 0.081. And so what 0.081 amounts to is that your return is 8.1%, is what that says. In other words, you've gotten operating income results that are 8.1% of the total assets that have been invested in this company. All right, next, return on equity. So here we simply take and divide net income into total shareholders' equity. And they give you the net income of 21,000, so that's nice and simple. And then, of course, you have your shareholders' equity given of 500,000. And so this is 0.042. What that means is that they received a return, the equity holders received a return of 4.2% on their investment. All right, so that's that. E, comment on the company's performance under these measurements. Explain why the return on assets and return on equity are so different. Not bad. I mean, certainly you have positive numbers, so, you know, in this day and time, positive is good. You would like to see return on equity to be about 5 to 10%. So that's a little low. You'd like to see this about 10%, so that's a little low. But overall, not too bad. I've seen worse. Let's see. What makes up the difference? Well, if you look at what they've got in other expenses, the stuff that's below operating income, note that they have a pretty good amount of interest expense. And so that's what makes up this difference between the 0.081 and 0.042 is interest expense. What the book says is interest expense of $80,000 on $610,000 of interest-bearing debt indicates an interest rate of approximately 13.1%. That's high. Obviously, it's not profitable to borrow money at 13.1% and then reinvest these borrowed funds to earn a pre-tax return of only 8.1%. Yeah, that's true. If Hamilton Stores cannot earn a return on asset that is higher than the cost of borrowing, it should not borrow money. Easier said than done. But anyway, that's what the book says. Okay, F. Discuss the apparent safety of long-term creditors' claims And so that's one. And two, the prospects for Hamilton Stores continuing its dividend payments at the present level. I would have to say that, you know, the interest expense is quite high. They're liquid. So short-term creditors, not a problem. Long-term creditors may be a problem. This company may need to do some debt restructuring or just pay it off and internally generate cash so they don't have to borrow at such high rates. They need to get it, or additional stock issuances. I mean, there's other things than borrowing money. Okay, you can finance your company's operations by other means than borrowing money. You can sell additional stock. You can sell bonds. That's not always such a great thing, but selling stock it means you don't have an outlay of principal and interest payments. You only pay dividends when you can. So it's probably the best way of doing this. What they might do is sell additional stock and pay off the debt so they don't have this 13.1% effective interest rate. Let's see what they say. It says here, long-term creditors do not appear to have a high margin of safety. The debt ratio of 61.5 is high for American industry. I'd have to say it really needs to be below 50%. So I'm not going to disagree with that. Also, debt is continuing to rise. During the current year, well, I don't know that. Do we know that? Oh, well. During the current year, the company borrowed an additional $56,000 while paying only $25,000. Ah, okay. In the current year, interest payments alone amounted to 1.44 times the net cash flow from operating activities. True. Two, the prospects for Hamilton Stores continuing its dividend payments. Probably not very good considering all that's going on. The book says if the current year is typical, Hamilton Stores cannot continue its $24,000 annual dividend. In the current year, investing activities consumed more than the net cash flow from operating activities. The company is not earning the money it pays out in dividends, it's borrowing it. Very true. If it were not for the $56,000 in borrowing during the year, cash would have decreased by $53,000 rather than increasing by $3,000. As the year-end cash balance amounts to only $35,000, the company obviously cannot afford to let its cash balance fall by $53,000. Thus, if the company is able to borrow the money to fund its dividend payments, or if they're not able to borrow the money to fund its dividend payments, these payments must be reduced or cut out altogether. So again, my suggestion to this company is exchange debt for equity by selling additional stock, taking the funds from selling the additional stock to pay off the debt, and then going forward they might not be able to pay as much in dividends because now you've got more shares outstanding and probably more shareholders, but at least you wouldn't have this onerous debt. So that would probably make their operations much more efficient and profitable. So anyway, that's it for me. You should do problem 14.6a following what we've talked about here. Okay?